Good afternoon and welcome to the ELECO plc investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Jonathan Hunter, CEO. Good afternoon, sir.
Thank you, Lily. Good afternoon, everyone, and welcome to ELECO's 2024 annual results presentation. Pleasure to have you all join us, and also introduce our Chief Financial Officer, Neil Pritchard, who's joining me.
Good afternoon, everyone.
Just as a reminder, for those that may be new to the story, ELECO is a leading developer of innovative award-winning solutions for the built environment. That's covering the early stages of building and construction through to operations, maintenance and management. We have 314 employees across our core markets, which are listed on the left there, primarily UK, Ireland, Scandinavia, Germany, Netherlands, Romania, USA and Australia. And we've got market-leading positions within those markets for our core solutions, but a huge opportunity to expand as well. So we will talk you through that as well. We've been going through a SaaS transition, so a transition from selling perpetual license software to subscription-based recurring revenue software and solutions. So 77% of our total revenue is now recurring revenues, with a minor part, 3% still on perpetual license and 20% on services. And we're very good at, customer-centric, but good at servicing customers in a direct way. So 96% of our sales and revenue is through direct relationships with our customers. What makes ELECO a great company is its people. We're really proud, it makes it a high quality business, and we are a people business, and that forms a foundation of our growth and drives our long-term success and innovation. So behind the results is really a great group of people with a great culture. We have got core values that represent, we believe, build high quality, high performing teams. And we've got great ESG credentials and innovation that's coming from within. And some of those innovation projects we talk about later in the slide. And in terms of what we do and how we service our customers, we are a technology partner in the built environment. We see customers, we work with customers for a long term. So we build a partnership and we continue to service them and expand year on year and offer them more value year on year. We address mission critical areas of the building life cycle, from early stages, early planning and estimating of projects, through to project management and delivery, as well as maintenance. And we have best of breed solutions, so very feature rich, mission critical, and they meet the needs of a diverse audience throughout that building life cycle, allowing them to prescriptively schedule, as well as upskill people, collaborate, report and manage safety on site. So with that, I'd like to introduce you to the financial and operational highlights for 2024. And we're very, very pleased to see and report that we've shown positive momentum as we deliver our growth strategy. We're seeing that the results are ahead of market expectations in terms of revenue, but also profitability and cash, and dividend to shareholders as a result of the good performance and showing confidence for the future. On the financials, the metrics are all heading in the right direction, but now with more pace that we've seen previously. And Neil will take you into the details of those in a moment, but something we're really proud of is the ARR, annualized recurring revenues, increasing, as well as total recurring revenues, so the reported revenues now at a level that's covering our overhead expenses for the business. So a business that's been resilient is now even more resilient in tough economic times. In terms of financial highlights, innovation is an area that we're very, I guess, an organisation we're very good at. We're a group of problem solvers and highly technical engineers. So, we continue to develop our core solutions as well as enhance those with modules and an ability to upsell more value into our customer base. One of our leading products is Asta Power Project, and that's won Project Management Software of the Year again last year for the 11th year in a row. So we're very proud of that, as well as further developments that allow for collaboration, as well as generative AI alongside that. With the use, when we're looking at AI, we've found that it's really supported us in terms of productivity and ability to quickly prototype and share new ideas with customers, which has been really encouraging. And something that's worth saying is, in terms of innovation, we do innovate alongside our customers. We work with some of the the leading companies in their field, which we're very fortunate to be doing. And that's how we've developed best of breed solutions. It's been through iterative development in line with customer needs and demands. And it's not only makes our customers base very sticky, but it's very difficult to displace. So we're in a very great resilient position in terms of our tech stack. On the M&A strategy, we made 2 acquisitions within the last 12 months. Vertical Digital we announced in the period in April of 2024. That's really integrated well and proven to allow us more R&D capability internally, but also to support our customers through their digital transformation journey. And post year end in January, we announced the acquisition of PMAC, which is a maintenance management software solution. Fantastic SaaS business with great people. We'll tell you a little bit more about how the integration is going in a moment later on in the deck. But we bought both of those businesses with cash, so we're debt free, and I think it's safe to say we're continuing the search to find really value enhancing businesses. So it's really quite exciting, given that we've got some core solutions that can really expand further with some acquisitions. And then we're very much focused on organic growth, not just M&A, and we see M&A supplementing that organic growth that has to contribute and continue that momentum that we've been building. So we're seeing strong recurring revenue growth year on year, which we're very proud of. We've been focusing quite intensely on go-to-market activities, enabling our sales teams to better sell and better pitch our value proposition, and that continues. It's ongoing, as well as group-wide training for our sales and marketing colleagues. Later in the period, actually in November, we appointed a Chief Revenue Officer, which is a new role within ELECO, and it's really taking that go-to-market metrics and best of class way of working further forward into 2025. So some great work going on in terms of forward visibility of pipeline and better improved metrics, consolidated metrics, as well as sales capabilities and so forth. So aligning that with customer profiles, and really some great things happening on the go-to-market pillar of our strategy. It's an area of focus alongside innovation and technology. And lastly, we're awarded certification as ISO 27001, so security standards. We already have 9001 business management standards, as well as being certified a great place to work, which we're very proud of. So the underlying business model and platform, we continue to nurture and develop that, because we believe that will drive further innovation and growth for investors. So I'm going to just double click on the financials and then introduce Neil to take over.
Thank you very much, Jonathan. Appreciate that. So yes, good afternoon, everybody, and delighted to present the financials for FY24. We have a December year end, so the 12 months up to there, and it's been a absolutely excellent year. Where we've experienced excellent growth, and as Jonathan said, ahead of market expectations across many measures. What I'd like to do first of all is just go through the highlights. I will have more detail for you on the P&L, a little bit more deep dive on the revenue, cash flow, and finally balance sheet. But first of all, the overall headlines here that you can see. So first of all, on the top section, revenue related metrics. As Jonathan mentioned, the ARR and TRR experienced really very nice levels of growth up by 18 and 20% respectively. The first one, ARR, is just by way of quick reminder, is the exit at the end of the period, so basically December recurring revenues multiplied by 12. The TRR is all the recurring revenues across the whole of the period in question of 12 months. And as Jonathan mentioned, the recurring revenues now represent a very high proportion of total revenue, so 77% of total revenues. And that's really important, because what that does is actually sort of provide that sustainability, that predictability of revenues going forward, as Jonathan mentioned, covering overheads and so forth, and kind of gives us the confidence and you know, that sort of window on the future, which is really helpful indeed. And you know, characteristically was sort of below, you know, 50% sort of back sort of 2020 2021 prior to the transition that we successfully implemented. Overall total revenues have surpassed the 30 million barrier at 32.4, as you can see there, and up 16%, which was, as we said, ahead of market expectations, and in constant currency terms actually higher at 17%, stripping away contributions from ongoing but still acquired businesses by 9% or 10% organic, with FX as well. So overall delighted with those sort of revenue growth metrics as well. On the lower section, the first two, adjusted EBITDA, adjusted profit before tax, you can see the growth levels there in terms of those metrics as well. And whether it's statutory or adjusted for one-off items, we're seeing profitability levels increasing by between 25 and 29% across the board, really, at different levels of profit, as you can see there. And that really is a demonstrator also of the more than proportionate profit growth, it says at the top of the slide, and what's called operational gearing. And you know, as more flows through at the top for a given sort of cost base, more flows through proportionately at the bottom as well. So really helpful to see that, and you know, providing great returns back to our very supportive and fantastic shareholders that we have. Also ahead of market expectations with the cash, that has increased by 3.1 million or 28%, as you can see there. Had we not made the small acquisition of the Romanian R&D business, project management business, in April of 2024, and paid for that, and together with a few associated advisor fees, then actually cash would have been 40% ahead year on year as well. And then in line with that adjusted EPS and that sort of delivery of underlying profitability and return to our shareholders, we have, as a board, taken the decision to increase the final dividend also ahead of consensus, in line with those sort of percentage increases, by 27%. And that does again reward, balances both that organic and that inorganic needs of the business that Jonathan mentioned, but also the returns to our supportive shareholders. I'll just move on to the next slide, which is the more detailed profit and loss account, and just talk you through some of the main items there, really. I won't focus on revenues because that will be the next slide. So I'll probably just start at the overall gross profit level. That's increased by 3.8 million in absolute terms. And while the margin is ever so slightly less, actually, if you take into account the slightly different nature, but for very good other strategic reasons of bringing in the contribution for the 9 months of the vertical digital acquisition, the margin itself would have been actually ahead even further from what are incredibly high gross margin levels to about 91%. And really that is, as I always say, a bit of a testament of the delivery of the value that we provide to our customers, and you know how loved we are in terms of our portfolio of product suite solutions for them. In terms of some of the other cost items, amortization, depreciation, amortization's ahead by about 0.8. Some of that, a little bit, is down to amortization of acquired intangibles, about 0.2. The rest up by about 0.6, which is reflective of perhaps a full year contribution of a 2023 part of the way through the year acquisition, Best Outcome, coming in for a full year for 24, but also just the increased levels of amortization because of the increased levels of investment in R&D, because we continue to innovate and be at the edge of that innovation as a business against our competitors and in the marketplaces that we serve. The acquisition costs and stamp duties really relate to both approximately half between the acquisition costs vertical digital and the gestation and the process of the second half of 24, culminating post year end with that Irish acquisition that Jonathan mentioned. And share-based payments change very little. And then other selling and admin expenses, on the face of it, ahead by about 11%, 2.1 million as it says there. But actually, if you strip away bringing in the cost basis of the acquired businesses, full year contribution for Best Outcome, also to vertical digital from their date of acquisition, then really you're talking about an underlying movement of about 0.8 or 4% or so, which is in line with both inflationary increases, which are predominantly staff-based costs, of course, and also obviously some senior hires as we scale up to really expand for the future. So therefore, at operating profit level, really nice to see that we are 28% ahead and 26% at PBT level, so forth as well. Effective tax rate is very, very similar, 22% between the two periods, so nothing particularly to comment on there at this juncture. Giving to an overall increase, as you can see there, the profit after tax, basic EPS up by 4, adjusted by to 5.1, 25 and 28% increases respectively. So that's really a quick counter through the P&L. In terms of a little bit more of a deep dive within revenue and a little bit of a commentary there on what's going on in the business, we continued to see a reduction in perpetual one-off licenses. There are small elements of the business where that's still operative, but less and less so as time goes on. So you can see that's very small percentage on the left-hand chart, on the left-hand column. The recurring levels, the 77% of overall revenues, you can see the improvement there within the period in question, financial 24. And then services, just to, in full transparency, while ahead here by about 0.7, or 20% of revenues, actually, if you take in the contribution for vertical digital, about 0.9, they were slightly down. That is the one area, very minor area of the business where we continue to see a little bit prone to, you know, macroeconomic factors and so forth. A large part being training related incomes that are viewed sometimes by businesses as discretionary and subject to change or slight delay. In the middle, what we see there, other than the fact that we are mostly direct to market, which is the lower chart, the upper middle chart really talks about the combination of the building life cycle business as a composition, other where we may act as a slight reseller with complementary elements, and also CAD visualization there in orange. And you can see that given the particularly high levels of growth, particularly within the building life cycle elements of the business, that's grown from 71% of the business to 74% of the business for FY24. And CAD visualization, proportionately, while element still growing, has reduced to about 20% of the overall business as well. Then finally, on the right-hand side, you can see a geographical split of the revenues. UK, obviously, notable movements within the UK, rest of Europe, which does include the remaining contribution, but also the expanding sort of Dutch business, for example, as well. And also the USA, nice growth, and rest of world. Scandinavia, while headline is about the same, actually in local currency terms increased between 3 and 4% in the period. It's Swedish krona to sterling there. And then the only one area where we see perhaps not so quite as much strength, and certainly within one area within Germany, is our visualization business, where what we've seen is, while it's a global business, it is more German and DACH area orientated, and therefore more related to the macroeconomic factors at play there, albeit that we now are seeing some improved signs of growth there, what with both the political situation, but also infrastructure spend and so forth, and improvements in GDP. So that's very much accounted also through revenue. If I come back onto cash flow, we're particularly pleased also with the cash flow. It's been an excellent year for cash generation and improved quality of earnings as well. I mentioned about the overall increase in the cash, of course, and by means of reference for those of you that perhaps know us a little less, we obviously have those high gross margins, we have high recurring revenues, we also have high retention rates with our customers, our valued customers, and so we have a business model that is resilient and very cash generative, great things in what are otherwise relatively uncertain times. The overall inflow, you can see a bridge there in terms of some of the bigger changes and so forth. For example, there's been some working capital. Much of that working capital you'll see on the balance sheet really relates to the scale up in the business and what's coming through in what's called deferred revenues. Revenues are postponed, but we'll see now as we go into FY25. And 3 million, the capitalized element of the R&D spend of about 5.4. The overall free cash flow is a particularly pleasant measure to report. It's 6.3 million against the previous 3.8, or up by 2/3. And also, not only that, as a proportion of our overall, as you can see in the bottom left-hand table, a higher proportion of our operating profits. So the cash quality of earnings really coming through, as well as the total cash contribution for the business. Overall, we saw that inflow that I mentioned, and of course, we don't actually have any borrowings either. And obviously, the cash can also go towards both organic investment in the business, dividends, and as we have been doing so in a progressive and sustainable dividend policy, and also for complementary M&A, where strategically and value enhancing, that proves to be a useful thing to do. If I then just finally move on to the balance sheet, most of the items here are relatively related to either scale up or bringing in the one-time balances relating to the Vertical Digital Romanian acquisition. So nothing sort of particularly to flag outside of those things really. It continues to be the case that we've improved the overall cash position as we mentioned there. So cash as a proportion of our overall net assets has now gone up from 40 to 46%. Our net assets has improved by 2.8 million, or 10.2%, which is a particularly nice increase to show within the period as well. And I mentioned earlier on the cash flow and the working capital about the deferred income. That's up by about 23%. Really very little, if at all, affected by anything timing differences around the Romanian acquisition. So actually all around the organic growth within the business that very much ties in with the overall ARR growth. So in conclusion, incredibly proud of the team to present all those numbers and ahead of those expectations, and yeah, really pleased, and thank you very much for all your support and your attention. I'll hand back to Jonathan. Thank you.
Thank you, Neil. So in this section of the presentation, I'd like to provide a bit more colour around the recent acquisition, PMAC, and also provide a bit more on the market and our strategy and how our customers use our products. So firstly, in relation to PMAC, we're really excited about this acquisition because the integration has been running extremely well. What PMAC is a maintenance management software, or CMMS, computerized maintenance management software, and it's complementary to our existing Shire Systems CMMS software. It's headquartered in Ireland, giving us a presence there where we have Shire System customers as well as construction and ASTA customers. And it's complementary in terms of tech, because or tech features, because it's servicing an audience that works in highly regulated environments such as health sciences and pharmaceutical, and anything that's USA sort of FDA approval in terms of food and beverage manufacturing. So there's an ideal customer profile for PMAC, there's an ideal customer profile for Shire Systems, and whilst the core functionality, there's probably 80% or so overlap, the areas that don't overlap, the 20%, is where you really win customers. And bringing the teams together within the first week actually was really exciting, and they're a really talented, experienced, enthusiastic team of people. So joining forces just generated so much opportunity, and within that first week we had leads being passed over between the different teams, as well as discussions on how to bring CRM, customer relationship management, information together. Since that was in early January, in January, since then we have it's given us scale and ability to form a marketing team that's dedicated to the asset maintenance and management customers, and also have a team focused on our construction audience, and also R&D have come together and exploring longer term roadmaps. The sales teams are working closely together. We're exhibiting together next month at Main Tech. So there's some great things happening, and it's, whilst we're managing that integration very carefully, the teams are thriving, and the scale is offering opportunities on both sides of the business. The feedback from customers has been extremely positive on both sides as well. On the PMAC side, there's a small privately owned business that servicing some really large international customers, and just might have a slide on that which I could show you, which give you more of a feel for the customer segments. But you see health sciences and some big brands there, and out of the customer list there was only one that overlapped, which was Kingspan, which we're very pleased to be working with on both sides. Highly forward-thinking customer, and received the news very well, so therefore we'll be doing a lot more work with Kingspan throughout 2025. And in terms of the internal employee feedback, it's been amazing as well. There's we've appointed a head of marketing from the PMAC acquisition, which is fabulous to see, and really energize the teams, the sales teams, and that's continuing. So it's just that having a bit more scale in terms of our small business is fantastic, and we expect to see more developments there. To move on to a bit about the market we're in, which is a really exciting space. It's the built environment, where there is still a lot of non-digital tools, pen and paper and spreadsheets and documents and things that are being used to manage building projects, but also maintenance of buildings and manufacturing facilities and so forth. And due to and that's even within our customer base that we know that there's a fragmented sort of mix of regional offices where they'll be using different software tools, and standardization is starting to take place thanks to AI and those sort of data. But still, it's an industry that is still digitally transforming, and whilst doing that, there's pressures on our customers. So higher demands from their customers in terms of building specification and design or complexity, but also regulation like the Safety Act we've seen in the UK, where there's further documentation that's required on site. So safety, compliance, material price volatility, skills and labour shortages, and ongoing productivity improvements and enhancements to deliver margins. I mean, the pressures our customers under in the industry is increasingly complex. And we solve many of those through our tools. We provide solutions that provide certainty of time and cost, as well as data that can be used. Our systems are the point where data is created, and that data can be used in multiple ways because that makes it mission critical. So we see many point solutions, many applications, and small technology solutions coming into the market, solving specific needs. We see those as opportunities for partnerships, maybe acquisitions, or maybe new competition, because a lot of those applications and technologies are linking back to the time and cost around a project to add value. So we feel very well positioned, very fortunate to have fantastic customers to help us keep ahead in terms of our innovation. Our strategy is based on a foundation of being a well-run business, so being a profitable, growing platform, having good organic growth, great talent and people and skills, as well as industry and customer focus and industry knowledge, and the culture and values as an organization, as well as ESG and good systems. And we believe that platform and business model allows us to be creative and innovate and invest in innovation. And I think that's where we're very good in terms of an organization, solving customer challenges and problems. And some of the developments like Asta GPT, which we released last year, was an employee-led innovation, so employee-led product. So we do innovate from within. And with that innovation, getting that into the customer's hands and ensuring the customers and the market understand how great that technology is really important. And that's where the next pillar to the left, go to market, plays a really important role and a really key focus for us as a management team to further grow the business. And we look at our competitors, we look at our customers, and we're doing some great things. We ought to be growing, continuing to grow and expand not only market share but within our customer base, especially as they're adopting more technology. And then the third pillar on the far right is mergers and acquisitions, and we principally look for three types of acquisitions. The first is a type A, which is a profitable SaaS revenue business that complements our existing markets, so we could perhaps cross-sell into our existing customer base or expand within a new geography. I think PMAC has provided that as a type A, as an example. And then type B is proven technology that helps advance our roadmap. And with our technology roadmap, we're looking further and further ahead into the next 5 and 10 years. And with that in mind, looking at what we could potentially acquire. So we're exploring technology acquisition opportunities, as well as partnerships, and then also what we would absolutely need to develop because there's no other alternative options. So we're constantly sort of integrating that product roadmap look ahead with our M&A and partnership and R&D strategies. And then the Type C acquisition opportunities are from outside of our built environment sector, and it could be technology that may be interesting to introduce into the built environment. So it's maybe posing slightly higher risk in some cases. And due to that, we have it there to continue being aware and ensuring we have an awareness, but I would say it's safe. We're confident in saying that Type A and B is probably the focus of our recent acquisition strategy. So with that, I'd just like to share 2 customer examples, which we're really proud of, to just give you a flavour of how we're providing value to customers, but also indirectly. And the first is Poor Construction, which is they're actually within the top 20 largest construction contractors in Europe. And we're supporting their German subsidiary, Poor GmbH, with their green and lean strategy using Aster Power Project, which is our scheduling, time management software, time planning and management. Poor's strategy aims to reduce their energy consumption as well as advance their compliance standards. And their strategy aligns to initiatives like the EU Green Deal and Paris Agreement. And what it involves is lean management to streamline processes and enhance efficiency and collaboration. So Poor integrates Aster and uses Aster as their project management system. They also, through Aster, have cost transparency as well as improve their quality. And they're also supporting local supply networks to increase their resilience and reduce their dependency on international providers for materials and so forth. So you can imagine in, like infrastructure projects that Poor's heavily involved in, logistics is very important, ensuring materials and equipment are in the right place at the right time. And, in order to deliver a project on time, and that's where Aster really has its strengths. The next client is MTA, which is a growing construction and civil engineering company who are based in Sweden. And sustainability is throughout their culture and business model. They use our BidCon cost estimating solution to estimate their material costs. But we've also provided a module to be able to estimate carbon costs as well, carbon impact. So MTA using BidCon for material and construction costs, as well as carbon at the early design stage of a building, which is helping them influence their design decisions, but it's also been proving absolutely crucial in delivering their environmental and social goals. So we're proud of MTA because they're a forward-thinking customer. They're pushing the technology, and resulting in that, they're pushing us further to push the technology and expand the technology. They're on our product council in Sweden, and they're a great organisation to be working with because they're getting value out of what we provide, but also providing us with value to further enhance our application in the real world. So it's just one example of a client that we're very, very pleased to be working with, and fortunate to be working with. So that concludes the formal part of our presentation. I'd like to therefore open up for questions.
Jonathan, Neil, thank you very much for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed by our investor dashboard. Jonathan, Neil, as you can see, we've received a number of questions throughout today's presentation. And Jonathan, could I hand back to you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Thank you, Lily. Yes. So thank you for your questions. The first received is from Frederick J. And the question is, well, comment, you're capitalizing some of your development spend, leading to cash flow conversion being lower than 100%. What is it that you're capitalizing here exactly? Thank you. So I shall hand that to Neil.
Yes,
to answer.
Certainly. In terms of our overall spend on R&D, for those of you sort of familiar with the rules, you capitalize based on your technical, both technical and commercial certainty of a product towards many customers obviously receiving a payback for that investment. And therefore, what happens is that research, everything's innovation, if you like, in terms of thresholds for those commercial and technical certainty to those end conclusions. That's when you can take things forward to be capitalised, and effectively the revenues in the future returning back for the investment of that sort of initial project period. In terms of the overall spend, there are some sort of minor roundings, but essentially 5.4 million for the total, of which about 3 million was development spend that you see in the cash flows you've mentioned, Frederick, as a discrete item. That's the capitalised one after operating cash flows, and then there's 2.4 million of R that's expense, and that flows through the P&L, which flows into the profit and loss at the top. So yeah, I mean, certainly in terms of, that's why we talk about free cash flow measures, and talking about, we don't necessarily publish a cash EBITDA, but you can do that and sort of remove development spend from there. But essentially what we're doing is that process, along with all technology and software businesses, of course. In terms of our overall spend, that's in the period that we're reporting was about 16.7% of overall revenues, which is consistent with slightly less actually than the prior year, where that was 17.2%. Probably worth mentioning here from a sort of prudence perspective, we do a number of things that probably, compared to our peers, that is probably more prudent, more conservative in terms of the R&D spend. So, for example, we tend to only capitalise when it's a brand new feature enhancement or a very significant enhancement, as opposed to a very minor or a cosmetic or a bug fix or anything else. So often you see with startup businesses, they'll capitalise absolutely everything they possibly can. So we're not like that. We're obviously long established with a proven track record, certain platform R&D elements, and ongoing maintenance, of course, but none of that obviously going to be capitalised. And also, you do find in some businesses that they tend to kind of park that investment and not amortise it until which you can do under the standards until later. Actually, we tend to amortise from the word go. So we're prudent in many fashions, really. And what does it represent in terms of the overall costs that you sort of refer to? It's really predominantly 85-90% is staff related costs. It's the costs and not just salary costs associated with national insurance, everything else that can be taken in, but represents the investment through very clever, very able software developers, obviously enhancing using some tools, representing some elements of that cost, fixed cost tools, and indeed even obviously increasingly so the use of AI as well.
Thank you, Neil. And thanks for the question, Frederick.
Thank you.
The next question is from Brian, and it is, given construction's historically slow digital adoption, how are you overcoming inertia among clients when introducing new technology like Astavision Live and Asta GPT? So I think great question. I think we're seeing, I guess, slow. We're not saying slow. We're saying, an increased level of adoption from our clients or the industry. But at the same time, the industry is becoming more complex. So it feels as though, as though there's a challenge there. So yeah. But how are we overcoming that inertia? I think the great thing is there's an interest. There's an interest in technology. There was a rapid adoption, of course, post-COVID, just to digitize, and then a realization that not all of that technology worked because it may not have been implemented properly. So therefore, better procurement, I think, from our customers in recent years. They're more savvy when it comes to buying software and investing in software. And they're looking at solutions that can fit their business needs in the longer term. So they can start with an entry level solution and then expand and expand the use of that software. And I think that's a key strength to what we have, because we can serve right at the sort of entry level, moving off spreadsheets, trying to manage projects in very basic tools, to the enterprise where you mentioned Astavision and those sorts of platform collaborative tools. We're also, as part of our strategy, has been able to enhance the value that we provide to customers, and not just serve one user within the customer base, but expand the usage. And therefore, what we've been working on is that go-to-market sales enablement, ensuring that we really understand the value proposition that we're offering, and ensuring our customer-facing colleagues understand that. Because it's at the bottom end, the entry level, it's very much a feature function based sale. It's very easy to say, to show, look, you can do it easier this way. But at the more strategic level, it's about, okay, we can ensure that your projects, you see sight of, a risk of delay much earlier in the process. And if there is a delay, you can use the software to reschedule and simulate and identify the best possible outcome to get you back on time again. And that recalculation and simulation is impossible to do in basic tools. So I think the value is being pitched more. I think we're continuing to expand on that, and that's going to drive a lot of growth through. It has driven growth in the period. I think it's going to continue driving growth. It's that, ensuring our customers are getting more value and understanding that value. The next question is from George, and it is, thank you, great print. Can you comment on the NRR, please, so net revenue retention rate? Thank you, George. Progressive.
Sure.
So, Neil, would you like to take that one?
Yeah, sure, by all means. So, thanks, George. Afternoon to you. With the NOR, we actually, Jonathan published within his statement, which is great, 109%. We're also very proud of that, and I think reflective of, if you like, the overall performance of the business in the period. In terms of the components, for competitive reasons, don't necessarily split those out or bridge those per se. But what I can say is, in relatively low inflationary environments, that isn't driven through substantial price rises or anything like that. It's really, they're sort of, of those sort of, and of course we are geographically, distributed across different suites and a portfolio of solutions, and in that sense, incredibly well diversified, of course, as well. But that would only sort of be typically sort of 2 to 3% sort of inflation levels that we've seen. Also, to sort of bridge another sort of element of jigsaw would be around the retention rates and churn. So again, we characteristically, we'll talk about our retention rates between 90 to 95%. So actually, the vast majority, while there are elements of cross sell, it's certainly more really about scale up and upsell. We grow with our customers, and our customers grow with us. And much of our innovation and our product offer and our customer offer is around the modularization and also value enhancements and the new innovations and so forth that we can bring, Vision Live and so forth. And so there's been that really upsell and scale up, and that's really the main driver behind the number.
Thank you. Thanks for the question, George.
Thank you.
And the next question, and last one, unless someone else also asks, is from Brian. Can you discuss what steps are being taken to scale your presence in the US market? And how do you see the competitive landscape evolving there? So, happy to take that one, I think. The US is, we're primarily focused on our construction scheduling software suite. which is Asta. We've established a reseller network there that's value-added resellers, so they're providing services alongside the software, and they serve many of the large sort of top 400 ENR, we call it, so the engineering news records of top 400 construction contractors in the US. And we've complemented that in recent years by also selling directly in the US. We've historically had more, in other regions, more success in our direct approach. So that's been the approach in the US in the last couple of years, which you'd be aware of if you've been following us. And we're also ensuring that we manage the channel and work with the channel, and the market is significantly large enough to be able to do that. So so there's a combination there of direct sales, marketing, customer success, and channel as well. And what have we been doing to promote ourselves? We've been attending many of the events, the industry events and networking sort of opportunities that are there. We're a member of the Construction Contractors Association, so attending many of their events as well. The recent one, Project Controls, last week, actually colleagues had reported that people are coming up and saying, we've heard of you and you're doing some great things. So we're getting more and more recognition, I believe. The competitive landscape, there is an incumbent that is Oracle, very used on many of the complex projects, as well as Microsoft Project, which is used more broadly. I think there's a report that suggests about 50% of the construction projects are managed using Microsoft Project. So yeah, some big brands that we're competing against, but we are getting extremely positive feedback for those customers we're bringing on board, and they can see the value, they can see the innovation that we have developed, and it's proven with winning the best project management software in the UK for the last 11 years. Over the years, we have tailored the solution for the US market, so it's got great market fit. It's all about continuing to build our brand and reputation and recognition. So we're when we're knocking on a door, they've at least heard of us. So we're seeing some good momentum. I think there's more to come. It's a big market. We're not overstretching ourselves. We're investing in line with the opportunity. And if the opportunity suddenly hit us, we've got a reseller network that can help us deliver, if we needed to. So it's a careful but very an approach that we believe is going to deliver further growth. So
Jonathan, Neil, if I may just jump back in there, and thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Jonathan, could I please just ask you for a few closing comments?
Indeed. Thank you, everyone, for joining, and thank you for your questions. We really appreciate them, and appreciate any feedback you may have. We're delighted with the momentum of the business, the quality of the business, and look forward to sharing our results, first half results, later in the year when they come. So good day to you all.
Jonathan, Neil, thank you for updating investors today. Can I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of ELECO plc, we'd like to thank you for attending today's presentation, and good afternoon to you all.